Hello, I'm Donald Leggett, and welcome to the latest Focus IR CEO interview. I'm joined again by Adam Davidson, CEO at Trident Royalties. And Trident is a very active, diversified mining royalty company. They're listed on AIM and the OTC, and they've just published a positive Q3 update. So welcome, Adam. And if you could summarize that Q3 update for us.
Yeah, I think for us, it was positive on the revenue front, which we can talk about later. But most importantly for us as a growth company is we made 2 acquisitions this quarter. So it's been a very active quarter for us, as you said. So it's been really good.
Okay, let's break things down deal by deal. The new royalty over the Paradox Lithium project has quite literally had a cracking start. So tell us all.
Yeah, that's been a great one. So the quick summary on that one was we acquired a pre-existing royalty over the Paradox Basin. The flagship project there is ASX-listed Anson Resources Paradox Project. It's a DLE, direct lithium extraction project. So another good lithium project in the U.S. Very advanced stage. They published their DFS, so their definitive feasibility study last year. Very good economic results on that study. And they've increased the resource a couple times subsequent to that study. Most significantly for us, after we acquired the royalty in September, they announced a 45% increase to the resource, which we had anticipated that was coming, but not quite to that degree. So really increases the scale of the project, and we're looking forward to the next step, which is the FEED study, which will be sort of the final study before you make a construction decision and go out there and raise money to build the project. So a good quality project in a good jurisdiction that's very well advanced and seems to be kicking a lot of goals for us.
Okay, if I could take you now to the Dandoko Gold Project in Mali, what sort of potential does that project have?
Yes, we acquired that royalty in August. It's a good exploration stage royalty. The slightly unique attributes of this royalty is that it's exploration stage and it's operated by B2 Gold, so it's a major. They bought this property last year for just over 90 million Aussie. They put a decent amount of money into drilling so far this year, so it's all moving in the right direction. And I suppose what makes it slightly unique for an exploration stage royalty is normally if it was in the hands of a junior, you'd have a long way to go from exploration to production. But in this particular case, because effectively the deposit is a satellite deposit to their operating Fekola mine, which Fekola produces 600,000 ounces a year at $600 an ounce cash cost. It's their flagship operation. This, they flag, could feed either directly into Fekola. They've highlighted in their recent materials a haul road that would go directly from Dandoko to Fekola, where they could truck the oxide material, and so we could see early production from that. And then they've also flagged the scope for a 4 million ton per year plant that would be fed by Dandoko and then another property, Anaconda, which we don't have a royalty on. And roughly at 4 million tons a year, and that recovery of that material in that area, that would be a circa 200,000 ounce a year production profile. So if you say roughly half of that comes from Dandoko, that becomes a pretty significant producing gold royalty for us.
And gold has done pretty well for you in the portfolio. I know you're a firm believer of diversification. Gold, you always tell us, is quite hard to come by in terms of decent royalties, but you seem to be doing pretty well, given that gold is not your main focus.
No, that's right. I think most of our peers are precious metals focused, and that's how we've tried to differentiate ourselves, is that we're building out a diversified portfolio. That said, we do want gold in the portfolio, and years like this year are the reason why. Gold has been bouncing up around $2,000 an ounce. There's been a lot of volatility in the market and a lot of macro events that have driven that. So we're happy to have gold in the portfolio. And in fact, as of today, it's the bulk of our cash flow is gold driven. So very pleased to have positioned ourselves in that way.
Okay, and back to hard rock lithium, Thacker Pass, which is your flagship project. What's the latest on Thacker Pass? Where are we with Thacker Pass?
So it's full steam ahead as far as we can tell. So the company, just after quarter end, bifurcated, the company being Lithium Americas, the operator of the asset. So they had 2 assets, one in Argentina and then Thacker Pass. They split those into 2 companies. That was the final trigger needed for General Motors to put in the second tranche of financing. So they've now put in this year $650 million. They're the largest shareholder of Lithium Americas, and of course have the offtake of the material, which they've noted will help produce up to 1 million EVs per year. And then Lithium Americas has flagged that they're putting in $145 million into construction of the asset in the second half of this year alone. We expect to see that ramp up, of course, next year as construction accelerates. So we're pleased. It's full steam ahead on construction, and we're starting to see a lot of activity there. So it's moving very clearly in the right direction.
And let me ask you about your revenues for the quarter and how you expect those to grow in the future.
Yeah, no, we were pleased with the revenue. If you exclude the Mimbula copper royalty, because that one, as long shareholders would know, that one had a minimum payment schedule associated with it, and once we fully recovered our capital, then that payment schedule falls away. And so we saw a drop on that one that was pretty big, because the mine is actually in ramp up now. So I think we'll continue to see revenue steadily increase as that project ramps up. But with the fall away of that minimum payment schedule, you see a drop in revenue quarter over quarter of 17%. That said, that was, of course, anticipated and is good news. We've gotten our money back and then some on the project, so that's great. And it's kicking off the beginning of its mine life, so that's what we wanted to have happen. But when you exclude that one, then we were up 18% quarter over quarter. So it's all moving in the right direction. We've been really pleased, actually, with our gold offtakes portfolio. I think every quarter over quarter, year over year, we're seeing more gold come out per quarter, and we're seeing more revenue. I think quarter over quarter, this quarter was a 22% increase over last quarter. So it's performing well. Q4 has obviously been off to a good start, given the fact that gold has popped here off some macro events, and volatility is quite extreme at the moment. So we're pleased with those. We're pleased with the portfolio in general. Really, for us, it's go out there and continue to add royalties.
Okay, and a useful question for investors. You hold cash of around $25 million US. If you could explain to investors how you actually pay for each royalty and how you actually leverage that cash, that would be very helpful.
Yeah, that's a good point. Something I should have touched on was when I flagged those two transactions that we did this quarter, Q3, both those, we tried to stretch that cash balance as far as possible. It's important to us, because what we don't want to do is go back to equity markets anytime soon. We want to let the value of the portfolio be realized by the market before we contemplate that. So what we did on both transactions was, on Dandoko, we paid about 60% of the consideration up front, and then everything else is production linked. And then on Paradox, we paid 15% of the consideration up front. So it's a headline $10 million deal. We paid 1.5. Everything else on that one is production linked. So not until we're realizing significant revenue have we actually paid the full sort of headline amounts for those two royalties. And for us, we believe that that's a smart way to try to stretch that cash balance. So we've still got $25 million in the bank, as you know. One activity that we're working on hard, and we've been pretty clear about since the very early days of Trident, is as you grow a portfolio and as assets like Thacker Pass become de-risked, banks like to lend to a portfolio like that. It's a good risk profile from their perspective. So we want to continue to lower our cost of capital, and I think to make capital available to make future acquisitions via a debt facility would be ideal. In that way, we can use our existing cash balance. We can use our shares. In most of our transactions on existing royalties, we use our scrip as well. Effectively, the vendor sells us a royalty in exchange for some cash and Trident shares. And then to be able to use a debt facility in a smart way, I think that allows us to really stretch our balance sheet to get the most out of it before we would contemplate going back to equity markets.
And when do you expect to be able to start doing that, would you say, Adam?
In terms of getting the debt facility, it's an ongoing project. When you're in the hands of big banks, you never do know. But it's all moving in the right direction. So and I think you've seen this progress to date. When we had our first facility, it was with a credit fund. It was higher cost. Then we moved to Macquarie Bank. Then Macquarie Bank lowered the coupon. So it's an ever-present work stream for us, really, since the early days of Trident.
There's a lot of geopolitical risk affecting market sentiment at the moment. So how would you describe the outlook for the company? And does all that geopolitical risk affect you negatively or positively?
I think we see some impact on the share price along with everybody else. But I suppose from our perspective, this is an ideal time to go out there and build out the portfolio. These are the times that you can get good royalties over good assets that would otherwise, in frothier markets, just go to the equity markets and raise equity to advance their projects. So in markets like this, what you see is people that hold existing royalties are monetizing them to drum up cash. And then projects that want to advance, but their share price is off significantly, they'll contemplate royalty financing, whereas in happier markets, they wouldn't. So although we're not immune to sort of the volatility of share price and everything else, I think from our perspective, we're going to look back on this period in a year or two time and say that was perfect. We've done 4 transactions this year to date. We're vigorously working away on other transactions and working on our debt as well. So I think we'll look back on the effort that was put in this year. The share price at a future time, I'm sure we'll be in a different spot, but we'll be pleased with the progress we made this year because that's really what underpins the value of Trident.
So what can we expect in the rest of 2024 and beyond? Can we expect some more deals? And what else is on the cards?
Yeah, there's not much time left in the year, but that said, we've been working on some stuff that we'd like to get over the line before the end of the year. As always, until you sign on the dotted line, you just don't know. But I think people can anticipate seeing some good news to continue from Trident, both from the existing portfolio. I think we'll continue to see good organic growth, which increases the NAV per share of the existing portfolio as assets expand and get closer to cash flow. But then also in terms of adding assets and working on our cost of capital. So a few key initiatives underway.
So my final question to you today, Adam, why should people invest in Trident? And the big one, why now?
Yeah, I think, well, why invest in Trident? I think hopefully that's become self-evident to people over the last couple quarters. It's a very volatile world out there, and there's one thing that the world needs, and that's real commodities. They need these real assets it's the economic engine that keeps everything together. You need these things for EVs, you need them for the grid, you need them for infrastructure. We've got exposure to everything from mineral sands and iron ore to silver, copper, gold, lithium, actively looking to continue to expand that offering. So it's the type of exposure that I take a lot of comfort from having within my personal portfolio. And then why now? I think a couple facets to that. One, I think our portfolio has never been in a better position, and yet our share price has come off in the last couple of months. When I look at where we were a year ago, for instance, Thacker Pass, while we were confident in the direction it was heading, it didn't have absolute certainty because it was still undergoing challenges to the permit. Now it's in construction. It's full steam ahead. That's going to be an operating mine in the future. And then we've added 4 assets this year, as I said, and all, I think, good quality assets that add to the NAV per share. And yet our share count is effectively the same as it was this time last year. So I think the value of a Trident share has only gone upwards. And with this kind of macro backdrop, I think having exposure to commodities and real assets that underscores the value of having that in your portfolio.
Okay, that's a great answer. Let's leave it there, Adam. That's Adam Davidson, CEO of Trident Royalties. Thank you very much indeed for your quarterly update and your operating update as well, really. So for more company information, please go to the Trident pages of London South East and think about adding Trident to your watch list. And meanwhile, do follow us on Twitter. That will be @_FocusIR_, also @London South East. And all that remains for me to do is to say thank you very much indeed for watching.